Thank you very much for joining us today. My name is Corey Daharsh. I'm with Advanta IRA, and we are here to bring you the topic of private lending through an asset manager. I've got a special guest today who works on the asset management side. Again, Corey Daharsh, here's my contact information. I'm a business development specialist with Advanta IRA. I've been in the industry since 2016. I've served a number of different roles with Advanta. So if you have any questions about self-directed investing or getting more education, feel free to reach out to me directly. And then my guest speaker today is Nathan Larsen. He is the Chief Investment Officer with the Mid-Atlantic Advisory Group. I've had him on to cover a very similar webinar in the past, and I am looking forward to having him on again, expanding on what he started with last time, and just providing you guys some great education on how to do private lending through an asset manager. If you'd like to reach out to Nathan and learn more about the Mid-Atlantic Advisory Group, feel free to take down his phone number or email address. He will also have a very detailed presentation a little bit down the line today in this webinar. So just to start off, we're going to cover a little bit of information about Advanta and the self-directed retirement space, and then I'm going to turn it over to Nathan for his portion of the presentation. If you're not familiar with Advanta, we are a self-directed IRA administrator. We've been in business for over 20 years. Our clients currently hold about $3 billion in assets that we have under management. All of our clients' funds that are not actively invested are insured with the FDIC, and all of our clients are paired with a dedicated client account manager. So once you have an account with us, you have a go-to one-to-one person that's there to assist you with any questions, concerns, getting your investments processed, and really making sure what you're looking to do and what you're strategizing on stays within the IRS's rules and regulations. That's what our expertise in, and that's what we provide, again, in a concierge, white glove style customer service account management position for you. If you've not heard about self-directed retirement investing, don't worry, it's actually pretty common that people don't know about this. Only about 4% of US-based retirement accounts are currently self-directed. And in the grand scheme of things, the industry of US-based retirement accounts, IRAs, 401ks, other types of US-based retirement products, has about $40 trillion in it. So of that, only about 1.5 trillion is currently being self-directed. And that's mainly because most people are with a fiduciary or a financial advisory company that has a vested interest in making you think that taking a self-directed route is going to be too scary or too volatile, because they want to hold your dollars and invest with your excuse me, invest with your dollars and charge you either a percentage of what they're making off the investments or a flat rate based on the account value you have. We're structured differently. We're not a financial advisor. We don't provide tax advice, legal advice, or financial advice. Again, we're just experts in what the IRS does and does not allow you to do with these accounts, and really lets you take matters into your own hands with your own investment goals, strategies, expertise, and so forth. So with a self-directed account, again, you can invest into anything you would like to. A lot of people have a fiduciary account and they have a product labeled as self-directed, but then when they go to actually utilize it, they find out that they're specifically tied to stocks, bonds, mutual funds on a list or a chart that they can choose from. A truly self-directed account or a truly self-directed custodian is going to let you invest into anything, that being real estate, mortgages and notes, or private lending like we're here to talk about today, other types of private equity, precious metals, basically anything you'd want to. I'll cover the rules a little bit more thoroughly in the next few slides, just so you can get a good grasp of what your interests are and where the rules surround what you would like to invest into. So the types of plans that can be self-directed are most of the IRA plans. Basically, most people are familiar with your traditional and Roth IRAs. Those are standard accounts. Anyone in the US can have one. You can contribute into those accounts as long as you have ordinary earned income. But if you're a small business owner, we also offer SEP and simple IRAs. Those are a little bit of a nuanced plan because they are tied to an employer, but they have higher annual contribution limits and a few additional benefits. We also offer solo 401ks if you have a business managed just by yourself, your spouse, or a business partner, and no rank and file or W-2 wage earners in that business. And then you can also self-direct health savings accounts or education savings accounts. So if you have any interest in those specific products or learning more about them, please feel free to reach out to me. I can provide you some great content or chat with you over what your needs meet and what specific account would fit best for you. So why do people choose to self-direct? Well, first off, if you're already an investor and you find that you have money in a retirement account, it's a great new source of capital to continue your investment portfolio and journey. A lot of people get fatigued with the stock market, so they get tired of the fluctuation of the stocks going up and down, and maybe over the past few years, more downs than ups. And then there's an inherent tax benefit to investing with your retirement funds because you're usually not looking to use these funds until later on in life when you reach retirement age, whether that be 59 and a half or reach the age where you are at what's called a required minimum distribution, meaning you've reached 72 at this point and start having to take money out of this account. But all the money you invest and grow in a retirement account through these types of investments grows either tax deferred or completely tax free if you've already paid the taxes on it and turned it over into what's called a Roth IRA or Roth funds within your solo 401k. So those are the key reasons we see people reach out and start self-directing. Maybe one of those fit into your criteria, maybe more than one. So if you are interested, again, it's a very easy and simple process to get switched over. And to that effect, I'm just going to very briefly cover how you can move funds into these accounts. So the two key ways people fund a self-directed account are either a custodian to custodian transfer or a direct or indirect rollover. So first, with a transfer, that takes place when you have an IRA with one custodian and you want to switch it over to another company. In this case, switching it from a managed custodian to a self-directed account. All you do for an IRA to IRA transfer is complete a transfer request form for the company you'd like to receive the funds. They submit that over to the back office of the company you're currently with, and that's usually facilitated with either a check or a wire within a few business days. Your new account's funded and you're ready to invest with it. That is a non-taxable and non-reportable event as far as the IRS is concerned. It's just moving from one existing IRA to another IRA of the same qualification or status. The other way people fund these accounts primarily is by rolling over. So if you have an employer-sponsored plan, like a 401k or a 403b or a 457 or a thrift savings plan, you can move that money over as soon as you terminate employment. You can move that money however, wherever you want to. A lot of people don't know that or don't think about that and have funds still sitting with the previous employer for years and years, where there's a chance, if that be your scenario, that that money is continuing to grow for the employer. But once you've terminated employment, they're not letting you cut in on any share of the earnings. So maybe look into that if you've got a plan from a few years ago from a job you've left. Also, if you are with a current employer, you may be able to tap into that money by what's called an in-service rollover. So not every time, it's specifically based on the agreement between your plan provider and your employer, but you may be eligible to do an in-service rollover while you're still employed somewhere and basically break off a chunk of your retirement funds and move it over to a self-direct account so you can start diversifying and making alternative investments with it. Those are primarily what I'm describing to be direct rollovers, meaning you're pulling the funds out of the account and moving it straight into the new qualified account. That is reported to the IRS on Form 1099-R, but as long as you move those funds straight into the new account, that's also documented on Form 5498. And just like a seesaw, as long as those dollar amounts match, there's no tax consequence for you. The only tax consequence would be money that you don't roll over into the new plan that you've taken out of the first or existing plan. And that comes to play when you do what's called an indirect rollover, meaning you take the funds out payable to yourself, put them into your own bank account, and from the day you receive those funds, you have 60 days, or called a 60-day rollover, or 60 days from constructive receipt, to put them into a new qualifying account. Otherwise, you do pay taxes on the money that you took out of that employer-sponsored plan. You are only allowed to do an indirect rollover once every rolling calendar year. So for example, if you did an indirect rollover today, you would not be able to do another one until May 21st of 2025. The final way people fund these accounts are with annual contributions. So every year, as long as you have ordinary earned income, you can contribute into one of these plans. And I really want to make sure I clarify with the audience today, contributions are completely different from earnings. You have a specific contribution limit based on the plan type you're using, but all the investments that you make within that plan and returns that those investments make are not considered part of your contribution. They're earnings generated from an asset that you hold. So your earnings are unlimited, but your contribution limits are set to a specific dollar amount based on the plan you have in the current year. Each year, they tend to raise the contribution limits a little bit, or maybe every couple years. It was going up consistently until COVID. When COVID hit, they kind of paused it for a while, but they're back on track with raising those limits nominally, but nonetheless raising those limits each calendar year. And back to the rules. So the rules around self-directing are pretty easy. You can invest into anything you'd like to with your retirement account, as long as it's not a life insurance policy or a hard to value collectible like antiques, fine wine, artwork, anything that would be subjective in value, meaning I think it's worth this because I'm an expert in this field. Someone that's not an expert in this field may look at that same asset and think it's not worth anything. It's a piece of junk. So in those specific cases, you're not supposed to hold those types of assets with your retirement account, but pretty much anything that does not fall into those classifications, you can hold in your retirement account. You just need to know the proper strategy and information on how to structure it, which is we're experts in. The other way that the IRS restricts you from retirement investing is by labeling certain individuals close to you as disqualified persons. So you're not able to transact with a disqualified person, but you can partner with them on a deal. So that's just, I can sit on the same side of a table as a disqualified person, but I can't buy, sell, or trade with a disqualified person within my retirement account. Just to give a clear example and explanation of what disqualified persons are, they include yourself, your spouse, and everyone up and down the main trunk of your family tree, and any businesses that those individuals own or control day-to-day operations of. So when I say control day-to-day operations, if you're making decisions that impact that business, and when I say own, it's 50% or more. So if they own 25% of a business, we would implore you to seek proper legal guidance and counsel before making the investment. But in theory, you can make that investment as you see fit. Those are really the only ways the IRS restricts how you use a retirement account. It's pretty simple. Again, we're here at Advanta, experts in these characters and fields. So please feel free to let me know if you have any questions or any nuances you'd like to discuss further. So a little bit about lending basics. I'm not going to cover this too thoroughly because that's Nathan's expertise, and that's what he's going to cover in his portion of the presentation. But a retirement account is allowed to lend or borrow money at the account holder's discretion. So you as an account holder can go out and find someone that's not a disqualified person to lend money to, or can even borrow money in the name of your retirement account. There are some nuances there about borrowing. That's a separate topic for a separate webinar, but if you want to use your retirement account to borrow, reach out to me directly and I'll point you in the direction of that content. In addition to vetting the borrowers, you actually determine what collateral you're willing to agree on if it's going to be a secured loan. You choose the interest rate, the down payment, the repayment window, and all of that set between you and the borrowers you're looking to work with. You're not allowed to lend to disqualified persons or collect collateral owned by disqualified persons. And some states do have different rules for private lending, so make sure you consult within your state or do enough due diligence and research within your state to verify the investment strategy you want to partake in falls within the IRS compliance. So that's the basics. If you want to directly invest into note lending or secured lending with your retirement account, if you're interested in that investment strategy, but don't necessarily want to be the one sourcing the borrowers and so forth, that's where you would partner with a larger group like Nathan's group at the Mid-Atlantic Advisory Group to actually source as an asset manager who the money needs to be lent out to, and they facilitate the transaction there. So you're just making a transaction with that group, and then they're taking that money once you fund the investment and handling different asset lending pieces as they see fit through their due diligence and their process and line of business. just a brief disclaimer, everything I've covered today thus far and everything Nathan's going to cover as well is just for educational purposes. We always implore you to consult your own team, whether that be an accountant, a financial advisor, attorney. Make sure you consult your own team and do your own thorough due diligence before entering any type of investment. If you were interested in this webinar and interested in further educational content, we typically put out 2 of those a week, every Tuesday and Thursday from 12 to 1 Eastern time. We've got a catalog of all of our previous webinars on YouTube. Just go to YouTube and search Advanta IRA. We do local events. We have an office in Tampa, in Atlanta, and I'm in North Carolina. So we do local events you can check out as well and meet us in person. Sometimes grab a free lunch and check out some educational content. We have a blog you can check out on our website if you're interested in industry news about retirement account investing world in an election year like we are now. Always at the cutting edge of any pending legislation that may affect retirement account investing. We participated in and really started a change.org petition last election cycle that helped take some legislation that was going to restrict retirement account investing and get that kicked out of the specific bill in question. So feel free to check that out. One final aspect, we have a podcast called the Alternative Investing Advantage Podcast, hosted by my colleague, Alex Perney. If you're interested in that, you can check that out anywhere you find your podcasts. Again, it's called the Alternative Investing Advantage Podcast. It's really easy to start one of these accounts. It takes about 15 minutes to complete our application. As I went over earlier, the account funding process typically takes a week to a week and a half, and then you could start investing into any asset you see fit from there. That pretty much wraps up my portion of the presentation. I'm going to go ahead and turn it over to Nathan to cover best practices for lending through your IRA with an asset manager. Nathan, the floor is yours.
Thank you so much, Corey. I really appreciate it. That's a great introduction. So we're going to cover a few things today, and the first thing is the main topic we're going to really focus on is as private lending and then private capital investing has become more and more popular with retirement accounts and with high net worth individuals. We want to break down the differences between doing that on your own and doing that with a partner to help you along the way, and what those differences really look like. As Corey mentioned, folks are looking for more stable ways, less volatile ways to deploy their money. The stock market roller coaster has made people pretty sick lately, and finding diversification and stability in your IRA is super important.
Nathan, real quick, I apologize. Before we get too far into the presentation, I do want to let the audience know that a copy of today's slide deck is in the handout section of the GoToWebinar panel. And we also do implore you to participate with us. So if you use the questions box, we'll be addressing your questions as Nathan presents, as long as they relate to his slide or his topic at hand. And if you have any questions that don't necessarily relate in the moment, we're going to go ahead and have a full Q&A session at the end of Nathan's presentation. So please feel free to participate with us. Download the handout if you'd like, or reach out to either of us after the presentation for a copy of today's handout.
So here's just a few of the 6 items that we're going to cover today, and we'll get to those as we start. The first thing we wanted to talk about was just the note lending basics. Corey touched on that a little bit. Really what note lending is, if we break it down, is we together, who are investing together, let's go to the next slide, we're becoming the bank, right? So we're the ones that, in partnership with our investors, act as the bank. We are transferring money from individuals that have it sitting idle into projects and businesses that have an eagerness to generate value in the project and in their local economy. And we would service those loans and collect those interest payments and payoffs, and we pass that interest along to our investors every month. So just a little bit about our team, just some background. This is our leadership team, and we're all on the call today, so you can ask us any questions. So one of my favorite authors, Neil Ferguson, a Harvard professor, has done a lot about the history of banking, the history of money, history of lending, and this is one of his favorite quotes that I always consider. an important way to think about lending. So as I mentioned before, what we do in this business is we basically become the bank as a private capital fund. One of the couple of just points that are interesting and that make this business work is the business grew substantially after the Great Recession with the Dodd-Frank passage. It created a lot of limitations and boundaries and guardrails for banks for good reason. And that opened up a lot of opportunity for private lenders, private funds, investment funds. And there's huge gaps in the banking world that provide very lucrative opportunities for lenders and funds like us. We come in and fill those gaps. A lot of times, even though they're lucrative, the small product types and niche product types are just too small for a larger bank to get involved with. Sometimes community banks will do more niche lending or more customized lending, but for the most part, if they can't deploy over $100 million or even $1 billion, they're not going to take the time to create a product, run through the legal hurdles, and create a team to promote it. It just doesn't make economic sense for them. And then that's where we come in.
So Nathan, just a quick question. With the Dodd-Frank Act, can you just at a high level elaborate, did that really get into place to kind of restrict the banks in a capacity, or counter to that to open up the private sector's ability to offer lending?
Yeah, so both. It created boundaries within the portfolio of the bank of how much concentration they can lend to within certain types of loans. So there's boundaries on how much business loans, how much real estate owner-occupied loans, how much real estate commercial loans, credit card receivables, all of the different categories of lending caps within the banks, and depending on the size of the bank, depends on the concentration limits with a sector of lending, a specific geographic footprint of lending, or a specific borrower in general. They're also limited by collateral types. So they've put lots of boundaries on banks, and so they have to balance that with their deposits, and it's not as easy to do that as it used to be. And so a lot of times banks will refer their depository accounts to us. And one of the ways that we get a lot of our loans is we get calls from banks all the time that say, hey, we've got a guy that needs this product, but we don't have that specific product, but the bank down the street may have it, and we really don't want to lose our deposits to that bank. Will you help him so we can help keep him within our bank doing business? So interestingly enough, that's where a lot of our business does come from.
Got it. All right, thank you very much. I just figured that some of the audience might not be familiar with the nuances of Dodd-Frank. I mean, I know we are in our industries,
Sure.
But just to kind of make sure everyone was aware. All right, I will mute and move to the next slide.
So one of the differences that we should touch on and how our industry differs from banking and from government-based lending is we do common sense lending, and it's relationship-based lending, right? So we're making pricing decisions and risk decisions that work in our portfolio, and we're pricing loans to risk versus pricing them to a government-based interest rate or a government-based qualifier. Our rates are typically a little bit higher than a bank. That is not because they're risky loans. They're generally much less risky, or at least evenly risky as a bank. We are faster, more flexible, and can get things done that are creative and common sense wise. We're not trying to make a loan to fit into a box. We're trying to make a loan to help someone and to make profit. And if that's an equitable exchange, we do those loans, whether it fits into a box or not. And that's the flexibility we offer that a bank doesn't necessarily have access to. Yeah, so we're going to touch on what a debt fund would handle and what an asset manager would handle for individual investors. So the first thing is Corey mentioned, a big part of our business is sourcing funds, sourcing customers to match with those funds. So if you decided as an individual investor that you wanted to lend $300,000 or $400,000 out of your IRA to someone, you would have to find that individual. You would have to vet that individual or that business. You would have to evaluate the collateral. And we'll see in a later slide that there's a lot of different things that most people don't realize come up in lending that can make it extremely difficult. We have done a time-tested model, 500 plus transactions. We don't have any losses in the portfolio. We've never had one investor lose money. And that's because we're extremely conservative with what we do, and we have a formula that we know works. And all of the investors are backed by the entire pool of receivables that we have, and there's so much equity in that pool, it's very little chance of that ever going sideways for any of us. One of the biggest things with us is due diligence. So this is relationship-based lending. We have a group of 40 to 50, closer to 60 now, probably different borrowers that we've lent to. These are typically business owners that are building homes, renovating homes, property and real estate experts in the community. And we've done business with them for 10, sometimes in many cases, 15 years or more. And we've done 10, 15, 20 loans for each of them. So they know what to expect from us, and we know what to expect from them. And we only do business with people that have a lot of money invested in their business and in their properties. So we're typically lending 65 to 68% loan to value, which means on $1 million piece of property, the borrower may owe us $600,000 or $700,000, right, in that range. So we don't have any losses or delinquencies in the portfolio because they're highly incentivized to finish the project. And if they aren't able to pay, then they typically would just sell the property and pay us off. So as we evaluate who and how we lend, we really focus on 4 specific items. Credit in our terms is more of a evaluating reputation. So what's their reputation like in the industry, in the community, with us personally or other lenders that we know. A little bit different than a standard credit report that a bank would use, but think of it as in evaluating someone's integrity and business ethics. The collateral is very simple. It's just how strong is our collateral position and how strong is the collateral itself. There's different classes of collateral. Typically, real estate is going to be the strongest class. You're also going to have things like cars, inventory, receivables, personal property. There's lots and lots of them. 90% of what we do is secured by real estate. Capacity is simply 2 things the way we think of it. Capacity is really their ability to pay back the loan and ability to make payments along the way, but also their ability to finish a project, their ability to complete the project they say they want to complete, and their history of doing so. And then character is just, do we want to do business with this person? Is this a person that we want to associate ourselves with? And as investors, would we want you guys to be associated with them? So those are really the 4 things that we focus on as we bring business to you for options and investment options. Next.
And Nathan, real quick, with the 4 C's here, are they kind of equal parts of a whole, or are they ordered kind of in that capacity, on purpose, or is there any one of these 4 that stand above the others when you're vetting out, deals?
So we wouldn't do business with someone that didn't check all 4 boxes, right? In what we do, most people I think would tell you that collateral is the most important, because if everything else goes wrong, as long as your collateral is really solid and you have a legal right to it, you can take possession of it and sell it, and a lot of times make money. The scenarios where we've done that, we've actually had a windfall of profit, not a loss. When banks lend, their typical loan to values are going to be 95 to 97%. Our typical loan to value is going to be more like 65%. So if someone doesn't pay us, We actually hope in most cases they don't, but they typically do because there's not any reason for them not to. So one of the main things to think of as using an asset manager or working through a company like ours through a retirement account is that we're taking what could be a very, very complicated business and we're doing our best to streamline it and present it in a way that is simple to understand, simple to sign up for, and flexible for investors. It's really a way to connect your savings with somebody else's ideas and ambition and effort, to give you an opportunity to share in a portion of that profit and in the form of interest. So a couple things we also manage along the way is sort of the unintended or unexpected or unrelated problems that could come up if you're investing directly into a business or through private equity. Corey had a slide earlier that mentioned, the UBIT issue, which is sort of the nemesis of business investors in qualified accounts. And what that is having income that's unexpected or unrelated to the intended business or the intended investment. In our investments, we are not distributing profits, we are distributing interest. So any money that you make from day one through the maturity of your investment is going to be distributed in the form of interest directly into your IRA account. So regardless of the channels that our business creates that revenue, maybe it's property sales, maybe it's consulting fees, maybe it's just pure interest coming in or a combination thereof. We're going to realign that and distribute it back to each investor, IRA or not, as interest distributions. So it eliminates any sort of unintended or unrelated business income that could potentially happen. And also, if you're going to be a lender and you're going to use collateral, which I would sure hope that anybody would if you're going to lend from your IRA, then you always have the potential of owning that collateral. If you're going to lend against it and use it as security, there is a chance that you may own whatever that is. So if you're trying to do this on your own and you live in California or Texas and you make a loan on someone that's 2 cities away or half the country away, and there's a property there or an automobile or a business that has collateral in a different geographic area, you may own that collateral. And that's what we consider accidental ownership. So you then have to figure out, okay, what am I going to do with this property in St. Louis or this business in Charlotte? That's on you as an individual investor. When you do it through a fund or do it through an asset manager, that is all managed within that business, and the ebbs and flows of that business, whether it's ownership or various different types of income, are pooled together and still transferred to the investor as interest distributions.
And just real quickly to add to the UBIT point, I did have it on my IRS rules slide earlier, as Nathan referenced. I knew he was going to be covering it from his perspective, so I didn't really speak on that. But those taxes, just for the audience's point of reference, they're typically at a little bit higher of a tax rate than your standard income tax rate. So this ability to utilize an asset manager and not have to really worry about that on your level as the retirement account investor could be seen as a very high sticking point for a lot of people that are interested in these strategies. I just wanted to share that briefly.
So again, it's using asset managers about simplifying what could be a very complicated business. So this is a list of some of the items that we as an asset manager and other companies doing this are going to cover for the investors. There's a lot to it. If you're going to lend and you're going to do it right, there's a lot going on that you need to be able to handle properly and follow the law in many cases. Most states have very specific lending laws. The US government has the Consumer Financial Protection Bureau that you could run afoul of very easily if you're not sure what you're doing or not sure what those boundaries are. There's a good amount to it. And so we have from start to finish created a program that handles all of these various items for our investors, and it offers them an opportunity just to plug and play their money and get a monthly distribution and make it as simple as that. So one of the other things about lending or lending to businesses or lending to private equity or just lending to individuals is that the returns can become kind of lumpy, right? Our business income, we have average months and we have fantastic months. And what you want as you get closer to retirement is to streamline and have predictable, consistent returns. Maybe you're investing in stocks and private equity or venture capital when you're in your 30s or 40s, but now if you're getting closer to retirement, you want a pretty even keel when it comes to returns on your money and limiting your exposure to the loss of your principal. And so creating a pool environment where we take, let's say, for example, 50 different investors who all put in $200,000, let's say, we put that into a pool and maybe create 20 or 30 specific investments in businesses and properties out of that pool of investment from those 50 individuals. What happens then is there's always different income coming in from those multiple assets that we invest into. And so even if those one or two assets have delayed income or delayed return, the pool of returns that we get averages out so that we can distribute that interest monthly to our investors in a very even, predictable way. And that pool effect is what allows that to happen. In addition to that, you're going to have not only the predictable income, but income consistency in terms of the distribution cadence. So you're going to be able to pick monthly, quarterly, semi-annual distributions and create a revenue stream into your household or into your retirement account that suits you very well. The other really great thing about this business is that we are distributing dollars, cash, into your IRA account that Corey was talking about is FDIC insured. So you're gonna, if you're starting to take your required minimum distributions, you're gonna have assets in the form of cash, liquid assets in there to take those distributions. A lot of investments, real estate funds, private equity funds are gonna have lockup periods. You're gonna put all your money in, it's gonna be locked up for 5 to 7 years. You might get a distribution at the end and it may be great or it may be nothing, who knows. But one of the great things about this is that it's going to put money every year back into your account that can be then distributed out on an annual basis as needed. You don't have to liquidate an investment or pull your money out of a long-term investment with a penalty just to be able to take that required distribution. So one of the things we talk about, again, is just the passive nature of this business. So to put it very simply, just think about creating a high interest revenue stream into your business, into your IRA, into your personal account that's flexible, where the terms, where you've just determined what those terms are and how often you want paid and what the dollar amount is. And it's just like getting interest from a bank account. Once a month, the first week of every month, you get paid. And there's really nothing much to it other than that. Just that you're earning 3 to 4 times as much as you would in a high yield savings account, a CD or money market account. And so instead of earning 2, 3, 4%, you're earning 8 to 10%. We can invest money inside or out of an IRA. We set up automated payments right into your account every month, right with Advanta. You can add your investment anytime with us. We have liquidation options that are as short as 90 days. And you get a lot of flexibility in choosing your rate, your term, your length of investment. And it becomes a truly hands-off investment where you can have the security of real estate, the consistency of earning interest through lending, but it becomes a completely passive investment. And so that's really the sort of pros and cons of doing it with and without an asset manager. So we can shift to any kind of questions that people may have.
There are a few questions that came in.
Yeah.
I've got this slide up here with a few links for you to check out more about the Mid-Atlantic Fund. I'll leave this up for a moment. So the first question I'm going to read off here. What real estate projects are these funded towards? Does the investor get MSB or mortgage-backed securities individual, or are they investing in a debt fund as a limited partner? What is the collateral for investor on the principal invested? I know you maybe covered that earlier. Maybe this person joined in a little bit late, but if you want to address kind of the context.
Yeah, so there's a few questions there. So the first question is what type of real estate is it? Was that the first question? You listed like four.
The first question reads, what real estate projects are these funded towards?
All right, so let's start there. So generally speaking, we're making what's considered commercial loans to residential properties. So it's a commercial loan in nature because we're lending to a business or an organization that is building, creating, or developing residential projects. So very limited in terms of categorized property that's zoned as commercial, very, very limited. What we generally do is our collateral is properties that are zoned residential, but we're making a commercial loan to a business entity that is then guaranteed. There's a personal guarantee that ties back to all the owners of those entities. What was the next one?
The next part was, does the investor get MSB or mortgage-backed securities individual, or are we investing into a debt fund as a limited partner? And then what is the collateral for the investor on the principal invested?
Yeah, so good questions. So we are not doing this on a GP-LP type scenario. That's a private equity scenario. So they are not limited partners. They are not equity holders. They are debt holders. So think about the investment into our business more like buying a bond in a corporate bond with a company than buying stock in a company. So you're going to get, as a debt holder in our business, you're going to get what's called the top of the capital stack. So think of it like a business, like a large Fortune 500 company that borrows money and pays interest on its bonds, but also pays a dividend distribution, right? So the investment in our business would be more like a bondholder, where they're getting an agreed upon terms and rate and cadence of payment, versus investing as an LP, where you'd be more like a stockholder hoping to get dividends, and the dividend payout would be based on the performance of the business versus a contractual obligation. So if you were an LP in a business like this, like private equity, you would get a K1 partnership payment every year. We distribute interest through a 1099 INT form. So it's truly pure interest income.
All right. And the next question, if the borrower does not pay and you get and sell the property, then we would not get interest, but instead profit from a sale. So is this UBIT?
No, you would not get profit from a sale. If the business acquired a property through its natural course of business, we would obtain that property and sell that property, and that money that we lent to the borrower, if it was, let's say our average loan is about $380,000. So if we put $380,000 out on it, we acquired the property, we sold it, the $380,000 that we paid out would come back into the business, and then we would return that by lending to another project once that money came back in. The investors in the business are not tied to one property or the performance of any given property. So they are going to receive monthly distributions at the contracted rate that they chose, regardless of whether we acquire properties or continue to collect payments on them.
All right. Just one further comment that I thought of in the context of your answer there. With
Sure.
these unintentional ownership situations, are you always, as a rule of thumb, selling the collateralized asset and returning there? Or has there ever been a scenario where maybe you do get an unintentional ownership and it actually has a high potential for income production? Is that something, have you guys ever experienced and held on further? Or is it always like our strategy is to sell that asset and return to the clients and move on to the next asset, or lending rather.
Yeah. So the boundaries of the company and of the fund allow us to do what's in the best interest of our investors in that scenario. So the intended business is not to necessarily own, manage, or invest or speculate in real estate. If we end up owning a property through the course of doing business, we're going to determine what the market looks like for that property and what the best scenario is for our investors. So if selling it immediately is best, we'll look at those options. If finishing, improving it, or building on it, or rezoning it, we'll look at those options. If it's a completed property, we're going to also look at, if the time is not right to sell it, we may put occupants in it. We may rent it or convert it to an Airbnb shortly, just so there's income coming in from that property that can be distributed. But our intent is not to have a portfolio of owned real estate. Our intent is to have a portfolio of receivables that are collateralized by real estate. So we do not have any real estate as of today in the portfolio. There's no owned properties. That's all collateralized debt obligations to our borrowers who are building properties or renovating properties or developing properties.
All right, the next question here, does Mid-Atlantic have skin in the game along with the investors? What are minimum investment requirements? Is this for accredited investors only? And just before Nathan gets a chance, if you don't feel comfortable answering the minimum investment requirement aspect, I implore that person to reach you directly. You can address that as you see fit.
Yeah, so the first answer is absolutely we have skin in the game. A huge portion of the portfolio is internal investments. So think of the business almost like a family office where we have huge amounts of our own capital in the fund, and we borrow money 3 different ways from institutions, other family offices, and individual investors to supplement that lending. So generally speaking, somewhere in the range of 25 to 30 cents of every dollar we lend out is our own money from either personal investments, business investments, or retained earnings that we've reinvested back in the fund. In fact, since we launched the current structure of the business in the fund structure, we've not pooled any profits whatsoever out of the business. We've taken every bit of profit that the company's made, and quarterly we reinvest it back in the portfolio of the business alongside our investors. In terms of minimum investments, we looked at the numbers last week. Our average investor has about $280,000 with us. So we technically have a $50,000 minimum that's sort of a teaser test drive it before you buy it type of investment that folks can get involved with. We don't currently have anyone in that, but we have had a few people that have used that in the past to just get very familiar with the fund before they made a bigger investment. This is much more of a boutique type of investment relationship than something like a crowdfunding or an internet crowdfunding would be. So we want to have specific aligned goals and a working relationship with all of our investors where we're communicating at least on a monthly, if not quarterly basis. And we want to get to know people and understand what their goals are, what their return, ambitions are, what their timeline and their horizon for retirement is. And we want to invest alongside them and do what's best for them. So very, very different mentality than sort of a crowdfunding mentality with thousands and thousands of investors that have a few $100 each in. That is really not what we do. It's much more personalized than that.
And then the final aspect of that question was accredited or not. I'm sorry if that was the context of your last portion of the answer there.
Yeah, so we have options for both.
And one thing I wanted to call back on the answer about the minimum investment, as Nathan did have in his presentation, with this type of investment, you can add to it whenever you'd like. So if you are someone that goes in at like a $50,000 increment and really like the way it's panning out, you don't have to wait to a certain date or set point to add to the investment. You can contact them back and enhance the investment at any point. Is that correct, Nathan?
That is correct, yes. So, and we've done that a lot, and I'm very comfortable doing it because I'd be the first person to raise my hand and say, let me prove it to you, right? So we've had a lot of people that'll come in at $50,000 or $100,000 and say, look, I've got $350, I want to invest, but I need to get comfortable around this first and get comfortable with us and the nature of the business. And so that's great. We love that. As long as there's sort of that future, if we deliver and we do what we say we're going to do, as long as there's a large relationship to be had, we're excited to do that.
Perfect. All right, well, we're getting close on time, so if anyone has a final question or two, please feel free to jot those down. I did advance the slide back to both my and Nathan's contact information, so please feel free to take that down. If you are a live attendee with us, you should be receiving a copy of this webinar, a link to the recording that you can watch within the next day or so if you want to watch any portion of it back. So please feel free to check your email for that. It should come out roughly in about a day. Again, Nathan, I really appreciate you joining me again and covering this content. I find it very valuable and insightful for those investors, as I covered at the beginning, that may be interested in private lending, but not necessarily interested in doing it themselves and sourcing their own borrowers, coming up with appropriate or accurate terms. So having a product and a service like asset management and like debt fund can be kind of the bridge gap for those people. And I greatly appreciate you sharing your information and knowledge on that strategy.
And this is my direct cell phone number that we put on here, and we only really do that for Advanta, but feel free to text me on that number. I'm a busy guy and I travel a lot with what we do, so I get to my email when I can, but shoot me a text anytime, and I'm happy to engage with you.
Perfect, awesome. I'm not seeing any final questions come in, and I do always try to be mindful of the audience's time, keeping us right about 1 hour. So we'll go ahead and conclude here. Again, please reach out to either of us if you have any questions, want to learn more about the Mid-Atlantic Fund or learn more about self-directed investing. We are both here to help you in our respective lanes. So please feel free to reach out, stay up to date with what we've got going on, and look to see you next time.